Let's first start off here with that latest housing data. A mixed picture here that shows, I guess, some degree of relief when it comes to mortgage rates, mortgage applications, and I guess potentially that might feed through into purchases.
Might be a bit of a stretch. I don't know. I mean, anything close to 7%, and this is still spitting distance to 7, means that housing is still, single-family housing, still very unaffordable. I mean, just to give you a sense of it, if you go back a year ago, given how low rates were and before the run-up in price, the more significant run-up in price, you're probably paying, what, $700-800 less a month on that mortgage payment than you are today. So just kind of put that into context. So for potential first-time home buyers, the market's still completely out of reach. And then for trade-up buyers, they got to make a pretty tough decision. Do I sell my home, go buy another one, get another mortgage, and the mortgage rate's going to be twice as high. The mortgage rate's going to be twice as high as the rate I have on the existing mortgage. I don't know. 7% isn't enough to 6.94. Let's put it that way. Isn't enough to get the market off the bottom here.
Well said, Mark. And I know that we've had many conversations with the FIAZZI conference, for example, a few months ago. And I think the keynote for me is you've always said that this time is different. Even though we're seeing some weakness within the housing market, you're not seeing the types of leverage or the weakness in the borrowers, the lack of down payments, the way we saw back in 2008. How is this time different despite what feels similar in terms of the weakness in the market?
Well, Taylor, this time is different. This is not the housing crash circa 2008, 2009, for lots of reasons. You mentioned, one, the quality of the borrower. The credit scores of borrowers since the financial crisis have been much, much higher than they were pre-crisis. Probably even more significantly and more obviously is the mortgage products. I mean, since the financial crisis, all the mortgage loans that have been long-term fixed rate, prepayable mortgages, 30, 15-year mortgages, very different than the kind of the weird 2-year teaser rate, subprime ARMs, neg am loans, ninja loans that, prevailed before the financial crisis. And so, people are on just more solid financial ground today. Yeah. I'd point out one other thing, investors. I mean, the investors are a much larger share of the market than they were before the financial crisis and during the financial crisis. In fact, the investor community was born out of the financial crisis. And I think they'll provide some, there's good and bad with that. I mean, there's some questions about what that all means for home ownership. But in terms of stability in the market, I think it puts a floor under price because those investors will come in once they sense value.
Let's talk about sentiment, particularly when it comes to consumers. And I'm curious as to what you make of the last couple of inflation reports, CPI, PPI, which did show some degree of softness. But I'm also curious as to whether you think some of the damage might have been done to the psyche of a lot of folks out there who've sort of seen this drumbeat of high inflation prints and may have retrenched to the point where I guess it's going to be a little bit hard to bring them back into the market.
Yeah, I think the inflation numbers have been good. I mean, relatively speaking, obviously. I mean, we're moving in the right direction. You mentioned the CPI, the PPI. Today we got import prices. They continue to decline. And you look at, other company level information data, you get a real sense that inflation is starting to roll over here and move in the right direction. I mean, obviously, some things have to go right here. We can't see oil prices go back up. We can't see China lock down again and cause supply chain issues. But it feels like we're moving in the right direction. And I do think consumer sentiment, how people feel about things, is very obviously closely linked to inflation, particularly those oil and gasoline prices. And as long as gasoline and oil prices stay roughly where they are and inflation continues to moderate, which, again, it feels like that's what's happening, I think sentiment should slowly improve, but only slowly. But here's one other, important point, Romaine. In terms of what it means for the economy, that it's not the level of sentiment that matters, it's the change in. So if we see, now big declines in consumer sentiment going forward, that would be a signal that we're probably going into recession. But right now, sentiment is weak. People don't feel good for lots of, obvious reasons, but it's stable. It's almost, the metaphor I have in my mind is they got the hand on the bunker door, but they haven't gone in the bunker yet. So, very fragile sentiment, but they're still holding on.
Yeah. How much does it cost to finance a bunker these days?
Well, a lot more than it did. And Romaine, you're learning all about the rate of change, the first derivative, not let alone the second
know.
derivative. Here we go.
You took calculus. That's great.
I know. We teach Romaine calculus in commercial break, Mark. Talk to us about how you're thinking about a housing recession as a leading indicator for an overall economic recession, because a lot of strategists have reminded us that it's hard to get an actual economic recession without weakness in the housing market. How much of that is a leading indicator to you?
Well, it's a necessary condition for recession. It's not sufficient. I mean, it's necessary because, generally recessions are caused. There are many causes, but at the core, you generally have rising interest rates. The Federal Reserve is worried about inflation like it is today and is pushing up rates. And of course, housing is the most rate-sensitive sector of the economy. I mean, most people who want to buy a home, they go get a mortgage, and of course, the mortgage rate really matters. So, housing is key to the slowing in economic growth. But and clearly the Fed's working really hard to slow growth, and that's not going to happen unless housing weakens. So this is by design, but it doesn't necessarily mean recession. At the end of the day, for recession to occur, the consumer does have to pack it in. They have to go into that bunker, and as long as they don't, and today's retail sales numbers suggest very strongly that they're still in the game. They're doing their part. They're hanging in, and as long as they continue to do that, that's not consistent with recession, despite what's going on in the housing market.
We're focused right now, of course, on the U.S. economy. I am curious, Mark, as to how much some of the issues going on overseas could actually feed and filter through to what's happening here in the U.S.
Well, you make a great point. I mean, obviously, Europe is, if it's not in recession, it's pretty close and probably going in. I mean, they got bigger problems with energy and inflation than we do, and their underlying economy is more fragile than ours. So they're probably going to go in. But the U.S. economy is, we do a lot of trading with the rest of the world, and there's a lot of flows and capital flows, investment, foreign direct investment. But despite all of that, we're still very much domestically oriented, and we can navigate through, again, with the American consumer hanging tough. And here's the other thing. If you go back to the teeth of the pandemic or back to the financial crisis, it was China that was kind of leading the global train forward. Right now, it's the American consumer that's leading the train forward. That's it's represented in the widening the trade balance. We're buying everything we're producing and a lot of stuff that everyone else is producing in the rest of the world. So to me, it all goes back to the consumer. Europe goes into recession. It's not great. Doesn't help. But we can still navigate through with troubles overseas if the American consumer can keep it together.